Our next guest is one of the world's most nimble and at times prescient investors. Back in August, he predicted that U.S. stocks would correct by 10 to 20% in the fall. They did, of course, and he correctly anticipated more volatility. Does anybody remember October the 15th? He's Marc Faber, editor and publisher of the Gloom, Boom, and Doom Report, with us via Skype from Chiang Mai, Thailand. Marc, good morning to you. Betty mentioned what happened in Greece. Prime Minister Samaras losing what amounts to a confidence vote, forced to call early elections next year. Take a look at the world around us, Marc. Is this a buying opportunity with Greek stocks and European stocks selling off, or is this a sell signal?
Well, first of all, I think that given the monetary interventions we have around the world, to make any prediction is very difficult. I mean, just go back 6 months. Who would have predicted that the oil price would drop by 40% in the fall? Or who would have predicted a month ago that natural gas would drop 35%? And that since October 7th, the price of wheat has doubled. So we have actually a lot of volatility. We have big moves in currencies, and we don't know how the world will look like in a year's time. But I'm basing my views somewhat on great Bloomberg reports, and I just read one that said that all the forecasters that were surveyed by Bloomberg forecast higher interest rates within a year on the 10 years Treasury note and the 30 years Treasury note. To this I respond that most forecasters have been bearish about bonds for years now. They always said bonds will go down, yields will go up. And actually in 2014, long-term 30 years U.S. Treasuries returned more than 25%. And the big surprise to anyone is how on earth could French government bonds decline to a yield of just 0.82%.
Marc, this is Betty here. So am I hearing that Marc Faber's prediction for 2015 is that you can't make a prediction?
Yes, that's actually the prediction of Barry Ritholtz, who works for you. So it's not even my view. I'm saying we will have a lot of volatility and a lot of surprises. That's why I keep on recommending diversification. And I'd just like to mention that hedge funds in 2014 and active money managers had a bad year. Almost 90% of active managers underperformed the S&P 500. And hedge funds, by and large, the average is up about 1%. But the portfolio that has actually done well is the all-weather portfolio of Bridgewater Associates, because they diversified. They were also in bonds, and they were long stocks.
Marc, this is Brendan. One of the words that you rely on a lot in your reports is the word discipline. You use that Warren Buffett quote. It's that you don't have to be smart, you have to be disciplined. You talk about that swing in the price of oil that nobody predicted. How did your discipline do, or did you lose your religion and make some trades when that started to happen?
No, actually, I'm a believer in trading as little as possible. So my portfolio turnover annually is very, very low. I'm a very bad client for banks and brokers because there are no commissions that are coming from me. So I'm diversified. I still think that the sentiment about stocks in the U.S. is much too bullish, much too optimistic. And the sentiment about U.S. bonds, say, the 10 years U.S. Treasury note is now yielding slightly more than 2.2%. Now, let me ask you this. What would you rather own, given that all the forecasters are so optimistic about the U.S. dollar? So what would you rather own? U.S. government bonds yielding 2.2%, or, say, European French bonds yielding 0.88%, German bonds 0.56%, or on Friday, the Swiss 10-year bonds went to 0.22%. So what would you rather own? I think the treasury market is not such a bad alternative, given my view that the global economy is actually slowing down, and given the low yields that you have in Japan and in Europe.
Mark, I'm fascinated. It's Eric here. I'm fascinated by a couple of points that you just made. The first being that you turn over your portfolio very rarely, and that, well, no, because many of the things that you have said to us over the last several years have been remarkably consistent, and that the performance of the markets has not been consistent, or has not been consistent with your outlook. So if I were to rewind the clock back to 2008, 2009, and we were talking about QE1 and QE2, you likened the U.S. dollar under Ben Bernanke to a piece of toilet paper, and you have been no fan of quantitative easing since then. Now, if we stuck with that view, where would we be today with the S&P 500 trading north of 2,000 and 10-year yields, as you point out, at 220?
Yes, the toilet paper status is still ahead of us for all paper currencies, not just the U.S. dollar. And what I have consistently said is that I prefer to invest in Asia and in emerging economies of Asia than, say, in the U.S. And as you know, some markets in Asia have performed substantially better than the U.S., particularly in 2014. A few months ago, I actually said and wrote that I was not optimistic about the Chinese economy, but that because of that, the stock market would go up. And Shanghai Stock Exchange Index this year is up 45%. India, which we also recommended a year ago, is up in dollar terms. I'm talking is up 25%. And even Thailand, despite of all its problems, is up 14%. Jakarta is up 18%. The Philippines 21%, and so forth. Pakistan is up 40%. So you can see there are other markets that have done better. And as I just explained, the treasury market has actually outperformed U.S. equities.
Yeah.
And then there's another thing I must mention about U.S. equities. As of early December, there were about as many stocks on the New York Stock Exchange that were down 10% as up 10%, and as many stocks that were down 40% as they were up 40%. So we have a huge diverging performance. If you were in biotech, you did very well. Interestingly enough, if you were in utilities, you did fantastically well.
Right.
And if you were in anything commodity related, you did poorly.
So we did see that divergence, Mark, but, as you mentioned, you say have a diversified portfolio. You would rather hold treasuries now than most other assets or other assets right now. But, Mark, what about in U.S. equities, though? What stocks would you own? What specific companies would you own in the U.S.?
Yes, I tell you, I prefer physical precious metals stored outside the U.S., but if you cannot own physical precious metals, I believe that whereas the sentiment about the stock market is bullish and about investments in general, and whereas I believe that most assets are in kind of a bubble, we have a credit bubble, I have to say that sentiment about precious metals is incredibly negative. And all these experts are predicting gold price to drop to $700. Well understood. These are experts that never owned a single ounce of gold in their lives. So they missed the five-fold increase since 1999. But they all know that the price of gold will go to $800. They write about it with a lot of authority. I may also say these are people that probably never gave a gold jewelry to their girlfriends and saw the smiles of these beautiful girls after they received the jewelry.